Joining me now to listen in and to analyze what Big Ben has to say is one of the most accurate economists, according to data that we compile here at Bloomberg. Joe Brusuelas, the president of Brusuelas Analytics, is here with me through the next hour. Thanks so much for coming in. So far, we have the testimony in front of us of what Ben Bernanke is saying. Extended period. When it comes to where rates are going, he didn't necessarily go where every economist wanted him to and address the timing here. You expected this.
Yeah.
Why?
Well, I think that it was a little too bad that he didn't, to be honest with you. If the Fed ever had the wind in their sails, today would have been the day to begin talking up the economy. But I'm a little sensitive to Fed head fakes in the sense that, look, we've got a elevated rate of inflation, unemployment. Inflation remains subdued. The housing market remains fragile. There are major fiscal policy problems out at the state and local levels, which he did address with one line, which did catch my attention. So that makes me think that the Fed believes that there are still problems out there. Moreover, we're going to have a tax shock next year when the Bush tax cuts expire. So the Fed looks to be moving very cautiously, not looking to raise rates, and that largely conforms with my expectations of what the testimony would say today.
Yeah, today of all days, we had a torrent of economic data. We had some positive data points as well from the business side of things, from Intel, from JP Morgan, and the Fed chairman today, though, even though he said he's seeing a little bit more strength on the consumer side, highlighted that he really doesn't like 44% of those unemployed have been jobless for 6 months or more. Made a point of drawing out the concern of extended joblessness and the possible impact there.
That's right. We've had a structural break in the labor market. We've got a reduced capacity overall to produce in the economy. And I think the Fed is actually fixated right now not on price stability, but maximum sustainable employment. And they're not going to move on the federal funds rate until they see a sustained decline in the unemployment level. Now, that doesn't mean they're not going to move on reserves. I expect that they'll begin drawing down reserves in the middle of this year. The language will change. I expect a June change in the statement, not the more robust April change that some of my colleagues had predicted.
A June move in the statement in terms of addressing interest rates.
Well, I think what they're going to do is they're already beginning to devalue the extended period phrase. They'll continue to do that, and I think in June they'll change the statement. That will cause a sell-off at the front end of the yield curve. We'll see a lot more hawkishness out of Bullard, out of Lacker, out of Honig, and even some of the senior, more key policy members. And that will then set the stage for what I believe to be the increase in the federal funds rate at the March 2011 meeting.
March 2011. Yesterday we had Dr. Doom, Nouriel Roubini, on this program, and he said to me that what's happening right now is an anemic, subpar, below-trend, U-shaped recovery, and he thinks the Fed is actually going to have to step in again with more QE. Listen in.
The Fed funds rate is going to stay at zero until at least the first quarter, if not the second quarter of next year, given we're going to have anemic economic growth and we'll have more deflation than inflation. And the Fed might try to start mopping up some of that liquidity, but I think that actually chances are they're going to resume further quantitative easing.
They're going to have to resume further quantitative easing. Do you agree?
Well, I don't think that they will have to at this point. We would have to see, one, another severe leg down in the market for housing. Two, and some sort of exogenous shock, i.e. a collapse in the fiscal positions of state and municipalities, perhaps a freeze up in the municipal bond market.
We did get that one line from the Fed chairman saying they are looking at state and local governments and possibly job losses as a result of some of their budgetary issues.
So that's something that we're monitoring quite closely. I don't think that that's going to occur, but if it does, then the Fed will move in very quickly, I think, to begin to bolster or, support the state and local governments, and the Obama administration will also move quite quickly. So I'm not that materially different from what Nouriel is saying. I'm just a little bit more optimistic based on the high frequency data I'm seeing now. We're seeing a pickup in tax withholdings. We're seeing a pickup and a broadening out of the economic recovery, which we really did see this morning in the retail sales, and that's one of the more optimistic signs we've seen in a number of months.
The consumer playing a bigger role.
That's right.